there's a million ways to do this, but I think you want to do probably some type of hybrid. What what I've heard Bill say when I listen to the old tapes, the old webinars, he would say if you have three stocks you're up 20 to 25% on, sell two of them. And which two do you sell? Well, ideally, what you would do is say you're up 28, 25, 22, then you would keep the 28. Also, ideally, the one you're up 28% on is the one you know the best. It's an Apple, a PayPal, a Square, a Google. That would make it easier to hold. But you want to take profits, especially if you're new at this. Bill would always say, take some profits. Just show yourself that you can do this, that you can make money in the stock market. Most people that I talk to, they tend to hold too long. They tend to ride them up and then ride them down. So I think you want to take profits, either what Bill would say, 2 out of 3, or maybe you could do a percentage. And that's kind of what I do. I almost always take some profits. And when I say almost always, I mean it's like 99% of the time. If that stock's going good and it's just, putting points on the board, I don't know. I just like to reduce the exposure. Now, I know we've got some guys on the portfolio management team that are really good. They're like rocks. They just watch those stocks go up and they just sit there, and then they pull back and they sit there, and then they go back up and they sit there. And it's amazing to me, but I know myself. If you look at Datadog, if you're in from, 98 down to 72, on the bad earnings, I know that I would react to that. I would get myself out. So I'm much better off selling it at 80. Watch it go to 92, and then when it breaks to 72, I don't have to worry about selling there. That's my, 27 cents. I know I went on a long
Oh,
time.
So
was
what
great.
is, so you say you almost, so say it's a perfect trade, breaks out beautifully, then, in a number of weeks goes up to that 20 to 25% profit taking zone. What percentage are you peeling off?
Yeah, I don't have a set percentage. I wish I did. It would leave me less seat of the pants. But Snowflake is a great example. I bought that, it broke out, and I just started taking off, sell 100 shares here, sell 50 shares there, and every sell was bad. It was 330, 340, 360, 400, and at 430, it's like, oh, here I go again, but then it breaks really bad down to 300, and I'm able to survive that because my position is much smaller. And then I can put some of my position back on. That's not my objective. I don't want to sell it to buy it cheaper. That's not a good strategy. I want to sell it to reduce my exposure, to allow me to sit better. It's because I know if I had my full position of Snowflake, believe me, it was a big position. From 429 down to 300, there's no way I would just be selling on the bad break that one day from like 350 down to 320. So I'm better off taking some off at 380, 390, 400, and then I can survive the pullback. And if I'm wrong, if there is no pullback, awesome, because then I still have some, not as much as I'd like to have, but I'm okay with that. I can live with that.
What about you, Chris?
It depends. Typically, if I get a nice breakout and I've got conviction about the stock, that I really like the numbers, I understand the story, I'm going to let that stock run. I'm not going to be taking money off when it hits the 20 to 25% range. However, when the market is feeling a little extended, and maybe I'm too invested, my exposure is too high, maybe I'm really on margin, that's when I'll start taking partial profits, and usually take a third in the 20% zone, and then maybe if it closes under the 21 day, I'll take some more off, things like that. So it's just kind of stepping back and forth with the stock and really letting it make the decisions for me ultimately. And if it just holds tight and goes up bigger and the market looks good, then maybe I'll be adding rather than taking shares off. So it depends on a lot of factors. I'm not an automatic 20%er, and part of it, why I feel that way, is we tested that rule on 3 years worth of leaderboard trades, and it did not improve our performance. So sitting with the stock really made the difference, and that's why we became so focused on the 10-week moving average.
If you're in the right stocks.
If you're in the right stocks,
and the right market.
Yeah, that too.
We're in a massive bull market. You guys have to understand, this is an amazing tailwind. So
Totally.
it's like we're driving a car going uphill, and it's like, well, what do we need brakes for? If I want to slow down, I just take off the accelerator. But the reason you have brakes is for when the market changes. And
that is such a great analogy, man. That was Edworthy.
I stole that from somebody along my lines. I wish I made that up, but somebody said that.
I knew that was too good for you, Scott.
Oh,
he's right. Justin is right. I admit it. But a guy said that, and I thought that's so true. When you're in a market that's good, you don't realize having brakes is you don't need it. But if you've studied history, good or bad, a lot of us have lived through some bad markets, and so things can change, so you have breaks.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.